Hi everyone, it's Jack back with another video doing a stock and earnings analysis today on a company that needs no introduction, that is Disney. $180 billion market cap company, one of the biggest entertainment companies in the world. It's had a rough year, down 36% year to date, and it's going to be down more tomorrow, down 6.2% on this graph. It's actually lower down right now. It's down around 9% after it released earnings about an hour ago. It's going to flirt with its 52-week low again. I think it could go below that. Looking at how the market's going recently, way off its 52-week high for $179, and a pretty brutal year, and a P of 58. It's not looking cheap, so I'm going to analyse these earnings, analyse some profit margins, the valuation, do a DCF, see if I think this company is a buy, sell or a hold right now. Like and subscribe and share the content. Let's get into it. This is Disney's Q4 report, so on the left is the quarterly numbers, and on the right is the year-end numbers. Revenue up 9% to $20.15 billion, and for the full year, nearly $83 billion, that's up 23%. The quarterly numbers missed estimates for revenue by about $1 billion, which is a pretty significant miss. Earnings per share also saw diluted earnings per share, excluding certain items, of 30 cents. That is down quarter over quarter, 19%, up 54% year over year with $3.53 of earnings. But the earnings for this quarter missed expectations by a significant margin. They were expecting around 50 cents of earnings. That was a significant miss. Free cash flow down 10% quarter over quarter, down 47% year over year, which is a frightening decline. And overall, this is a company that, in my opinion, is just not producing quality earnings that it really should be for its valuation. That free cash flow of $1 billion for the full year, $180 billion market cap, that's 180 times free cash flow. That is a very expensive stock. This business is split into two distinct segments. Disney Media and Entertainment Distribution, that'll include Disney Plus, or the film division, Hulu, ESPN, blah, 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 and the Disney Parks and Experiences products. Now, the media and entertainment distribution business is about twice as large as the Parks and Experiences and products, and it was up 8% for the full year, $55 billion. It's actually down 3% for the quarter, year over year. Disney Parks and Experiences was a bright spot, up 36% year over year for the quarter, and up 73% year over year for the full year. However, it is coming off against very weak COVID comparisons, where in 2021 a large majority of the parks were shut for at least some of that year. So I'm not going to give them too much credit here for just reopening the parks essentially and getting big numbers. For segment operating income, the media and entertainment distribution was down significantly because of much larger losses at Disney Plus, some less theatrical distributions to blame for the revenue, and larger losses than expected at Disney Plus. $83 million of operating income versus nearly $1 billion last year. That's a significant decline, 91% loss, and it's lost 42% for the full year, losing all $3 billion of income, which is, to me, is a tremendous loss. Disney Parks and Experiences, again, because it's reopened, these comparisons are absolutely ridiculous. The operating income is around $8 billion versus $471 million, so clearly absolutely outstanding growth, but really from incredibly weak comparisons and kind of just about where it was in 2019. The real needle mover for Disney Plus going forward, and what seems to be everyone's talking about, is Disney Plus. Disney Plus, CEO Bob Chapek was speaking out. While it is a loss-making endeavour right now, it is narrowing its losses, and they believe it's going to be profitable by 2024. It is growing subscribers at a fantastic rate, adding 20% increase year over year. There are now 46.4 million domestic subscribers, 56.5 million international subscribers, excluding the Disney Plus and Hotstar thing in India. So Disney Plus Core, 102.9 million, and Disney Plus and Hotstar, 164.2 million. That's 39% growth year over year. This is growing like a weed. It's only 3 years old, which is absolutely fantastic, but that is a real drain on Disney's free cash flow, and it kind of needs free cash flow right now because it doesn't have a fantastic balance sheet, and 180 times free cash flow for this stock, I can see it plummeting really quickly in my opinion. ESPN continues to grow really strongly. I'm a big fan of ESPN Plus in this business. I think it's an excellent addition, 42% up year over year. Hulu, which I think is kind of an also-ran in the streaming business, not really one of the giants, up 8% year over year, continued strong performance. What is worrying is the average monthly revenue per paid subscriber trends. It's basically ARPU of the social media world. Disney Plus down 10% year over year. That's basically because of Hotstar. That's down 9% year over year. But the Disney Plus core was still down 4% year over year. ESPN Plus, and again another bright spot, up 2% year over year. But Hulu, basically flat, down 4% year over year. Not very impressive. ESPN Plus continues to be a bright spot, but Disney Plus, these average monthly revenue per paid subscriber numbers are a bit concerning, and they are going to struggle for profitability going forward if this is the case. Disney pretty much always trades at a premium to the S&P 500. It's been a consistently profitable business over many years and an excellent returner. It pays back a small dividend, returns cash to shareholders, and generally is something that is not going anywhere and has some good growth pathways with decent gross margin around 34%. However, right now I think a PE ratio on a trailing basis of 58 is absolutely unjustifiable. I think the forward PE ratio here that I'm seeing is probably a little skewed. Analyst estimates won't have been updated yet because I do not think they're going to be more profitable than they are right now next year. It's certainly not by that scale. So I think we'll be looking at a PE of 40 plus next year. Is that justifiable versus an S&P 500 on a forward basis of like 15? Absolutely not. Price free cash flow of 150 on this graph. It's now 180 after this disappointing quarter for free cash flow. I think this is a business that is extremely overvalued right now based on these metrics. Of course, all these metrics are somewhat depressed versus previous years. However, they are going to be spending a lot of cash on Disney Plus going forward. It is going to be making losses, and it is going to be eating free cash flow. And I just don't think in the next 3 or 4 years Disney's ever going to look cheap on this basis. Of course, you have to discount some growth going forward into the future, but I think for a true value investor, Disney is a pretty poor investment based on these metrics. I put this calculation in more to just illustrate the scale of Disney's overvaluation right now. If you do any sort of DCF calculation or any sort of reasonable DCF calculation, this is an incredibly overvalued stock. So for example, I've just put in a 10% free cash flow growth rate over the next 10 years using its current free cash flow numbers, which are around 66 cents per share, something like that, and a 9% discount rate. You're looking at a fair value of around $12. That's an incredible premium. The stock price right now is an incredible premium over that fair valuation, and really I just cannot justify this business. Over the last 10 years, its free cash flow has been declining at an average of 5% a year, while as a tough few years, it's really been a putrid stock from a free cash flow growth perspective. And I think in the longer term, I think people are going to start coming around to this business. I really can't understand why it is valued so highly when it's fair valuation and the metrics are so poor. Looking at this stock chart right now, I can really only see this stock going in one direction. It's going to lose probably 10% tomorrow. I think that's absolutely justified. It missed its earnings expectations by a significant amount. It missed its revenue by a significant amount. It's going to be valued at 180 times free cash flow, which is absolutely ridiculous for the growth profile of this company. And I'm struggling to think of any positives really. Of course, it's a strong growth trajectory. It's going nowhere. It's a relatively safe business from that point of view, but it's eating cash. It's actually cannibalizing itself if you think about it, because Disney Plus is eating theatre sales, and it's not really gaining that much revenue if you think about it, because it's just going to be eating its own theatre sales. I think this is a deeply troubled business, and while I think it will be fine over the very long term, in the short term I think there's a lot of pain coming for this business. While Disney Plus continues to eat at its cash flows, we could potentially go into a recession. This company on a valuation basis, particularly like PE, is going to look absolutely ridiculous in 2023 in my opinion. I just don't think it's a stock that I would be comfortable investing in right now, although over the longer term I think it can be an absolutely competitive business, and I think it will be a much larger company in 15-20 years. I just don't feel comfortable investing in these valuations, and I could quite easily see Disney dropping to $60-$70, if not lower, if we go into a severe recession next year, as many are predicting. Of course, this is just my opinion. You should let me know what you think of the business. I'm absolutely happy to be proven wrong here, because I think this is a good business that I would like to own if you could sort its act out, because I do think there's a nice growth trajectory for many of the products of this business. I think in terms of IP, it has the potential to dominate the streaming landscape. However, I'm just not comfortable investing at these prices. With that being said, let me know what you think in the comments below. Like and subscribe and enjoy the video. I'll see you again next time.